All right, so we're going to go ahead and turn this over now to Ben and Jared and get started.
Thanks, Amy. This is Ben. I want to thank everybody for attending today. So I know this is a very compelling topic, so fun for us to go through. We do this every year. Now some things have changed since last year, so got to pay attention to those changes if you've attended before. We'll go over those. Both Jared and I have enjoyed presenting this in the past, enjoyed the questions that you guys have sent. Just a little bit about me and Jared as our background. So I'm an attorney by training. I head up the tax controversy and procedure practice for Eide Bailly. I'm a former IRS attorney and I was during that time a special assistant U.S. attorney. I usually don't mention that, but the reason why I mention it here is because in that role I had a lot of work enforcing summonses and helping agents obtain information from foreign jurisdictions. Jared is in our international tax office, and he's our resident, one of our resident international experts and a specialist in individual tax, and of course these filings and penalties that we typically come across. Jared, I don't know if you want to add anything else about your background.
No, I think that's good. Thanks, Ben.
Okay, so we have our learning objectives that we'll go through here. If you can move to that slide there. Yeah, so generally, these are kind of broad, but we'll discuss, the reporting requirements and what the IRS regulations require. Now, there's some subjective things that we'll go through, but typically, these are kind of draconian measures that were put into place to make sure people don't hide their foreign assets. So these are some tough regulations and some tough rules. We'll go over each of these penalties and how steep they can be, but we'll also talk about how to mitigate those penalties and even fight them if necessary. And then Jared's going to do a great discussion over describing all the different choices you can make, considering that some of them have disappeared. It's good to know what now can be done for clients or you individually if you have any of these issues. So with that, we'll kind of start off with Jared going through some of these forms. There's a lot of them, and you don't have to memorize them, but you can come back to these slides if necessary.
So welcome everybody this morning. It's good to be with you here. We will talk about these international disclosure forms first and foremost. So here's a list of them in summary. So these are what I refer to as the most common international informational disclosure forms that the IRS has, and the one that, as you can see from this slide, there are some of the many. These are the forms that require that they're required by the U.S. government. A lot of people wonder why the U.S. requires so many different forms. They require them basically to fight money laundering, tax evasion, even the support of, or to combat the support of terrorism. And so you can kind of see, as we discussed today, the various penalties that are out there are designed to combat these issues. And so that's why the penalties are so severe. Unfortunately, a lot of innocent people get caught up in these same penalties and schemes. So it can make things very difficult if you run afoul of these reporting requirements. We're going to talk about a lot of these. The first one and the most common, the FBAR, I'll talk in more detail, but Form 8938, which is a sister form of the FBAR. 3520 and 3520A, these are for foreign trust reporting, foreign non-grantor and grantor trust reporting. There is the 8865, which is used for the reporting of foreign partnerships. 5471s, which is very common more and more common now is the reporting of foreign corporations. And 8858 is the reporting for disregarded entities. And then last of all, this is one of the most complex issues of all of them, which is Form 8621, which is the reporting of passive foreign investment companies, or known as PFICs. So we'll kind of talk about each one of these, but these are the ones that we most commonly see. So that brings us to, let's see here. The most common one, which is the foreign bank account reporting. So I talk to people regarding the FBAR every day, and a lot of common questions come up, and many times it's asked, well, how many years has the FBAR even been around? And so as you can kind of see here, it's been around for a long time, since the Bank Secrecy Act of 1970. People are very surprised when they hear that. And a couple other things to know about the FBAR is the large civil penalties that we'll talk about began in 2004. And then another item, so as far as the form switched from an older form to FinCEN Form 114 a few years ago. And this is now the FBAR form, and a lot of people call it as FBAR, which is an abbreviation of foreign bank account reporting. And so you can kind of see, you can see here that the filing obligation for an FBAR starts when you have accounts in aggregate of $10,000 during a calendar year. And another thing, a couple things I just want to touch on here is, a few years ago, it became required that FBARs be e-filed. They can no longer be paper filed unless you get a special exception. So the filing deadline also changed a few years ago. It used to be a June 30th deadline. It is now an April 15th deadline. So that lines up with the personal returns, which is really nice. The other thing that's really nice is there's an automatic 6-month extension. So you don't have to file an extension to get the 6-month extension. It's just automatic. So technically your filing deadline on this every year, reporting on a calendar year, is October 15th of each year.
So you're telling me you even have to file this even if the account isn't one that accumulates interest or makes any money?
Yes, you have to report any account that is held within a foreign financial institution. So that could be a life insurance account, could be considered a life insurance company, could be a foreign financial institution. So yeah, it encompasses a lot, and because it's informational in nature, I like to err on the side of caution. If you're uncertain whether, and there are certain accounts, whether or not you should report them, kind of like Bitcoin accounts. There's the rules on that aren't very clear. And so if there's room for doubt, I would always err on the side of caution to report. There's no tax consequences with it. It's just merely the filing obligation, and it protects you from these draconian type penalties that we're going to talk about. The first polling question, Amy, I'll turn that over to you.
Perfect. All right, guys. So the first polling question is open, and it is, have you ever had a foreign bank account reporting FBAR obligation? Yes, no, or what is an FBAR? Please go ahead and answer that. Polling questions will be for CPE credit. You don't have to have the right answer. Obviously, there's not a right answer on this one. We just want to get your feedback. So,
thank you, Amy.
Of course.
As those are finishing up, I'll just I'm just going to comment here while we're waiting. So the world is getting smaller, and so I'm seeing more and more people that have ownership in in foreign bank accounts. That isn't translating here in the polls very clearly, but it is. Every day I'm talking to somebody about this topic, and so I would, if you're a tax practitioner, I would make sure that you're asking this question to all of your clients every day, because more and more people have these types of issues.
Or a few more questions about, because they might assume that just means bank accounts, right?
Yeah.
And not in your life insurance or what have you.
Very good. Yeah. Yeah. Just going, like, if you know they have foreign assets, it's good just to start, put it all down on a worksheet. Let's work through every one. Let's determine what type of filing obligations that you have as a result of, of those foreign assets. So, well, it looks like everyone voted and the poll is ended. So yeah, just a couple have filed FBARs. And so anyway.
Okay, so let's talk a little bit about, just a little about IRS audit procedures, kind of what happens, what tools they use, and kind of what the statute of limitations are. So, with each one of those forms Jared talked about, there are potential audit exposure, and there's different, lengths of time that they can cause problems. So, that all came from different laws. Most recently, there was FATCA that required all these different filing obligations. Now, you may be audited in probably kind of 3 different ways. You could, most common is when we submit things through a program, I guess you could call an audit, Jared, where they want to pick it up and investigate it further, right? But also where you could have a direct international examiner that is auditing you specifically for your international transactions. You could have a regular income tax audit, and they pick up your international aspects as part of that audit, especially in large business and international audits. It's all part of the audit. They'll ask you right up front, what are your international transactions? And then they'll move forward with that. So basically what you need to know is that these agents are kind of what they're looking for. We'll talk more about the definitions of some of these things, but they're trying to determine basically if you failed to report something that you were required to report, and whether you were non-willful or you were willful. And that can be very subjective, and we'll go over the specifics of that. But they're gonna oftentimes, even when they had somebody advising them, they may have a different understanding of what an entity was, or like that maybe they didn't know that there was a insurance account that was really a financial institution account. Because of this, you have to be careful of these broad implications. Now, of course, they could also be after you because they believe you have unreported international income tax aspects or unreported income. So you got to remember is that some people think, and I've heard, I've seen things on the internet and even on television that imply that, if something's foreign, it's much harder for the IRS to get. So I just want you to know, kind of in my experience, the IRS has strong tools to get that information. Now, first off, they can just ask you directly in what we call an information document request. If you don't provide the information, they can issue a summons to you, to your accountant, to your financial advisors, to your attorneys, and they can even ask for, obviously banks and those financial institutions. Some people think, well, if my bank is a foreign bank, can they really get that information? When I was with the IRS, we had a lot of defiant people tell us that you can't get that information because it's with my foreign bank. That's not necessarily true. A lot of these banks actually they may be a foreign-based bank, but they have U.S. branches. And so we would summons information from the U.S. branch, or if it was what we call a correspondent bank, you could get the information through these transactions that go back and forth to that foreign bank, you can get that information from domestically. There's other ways to request foreign documents. So one that we typically used with a lot of these defiant taxpayers, I was specifically involved with the offshore credit card program where people would put money offshore and then they would access that through a credit card. One of the ways that we would use that own defense against themselves is you can do what's called a 982A. Basically you're saying it's if you don't give us these documents, you can't use them in court later. So we'd issue a summons, they would refuse, and we would basically say they couldn't use them later. If we had enough information to show they had money being transferred over and we could assume it was income, that would often be used. There's also consent directives. If you have a summons and they refuse to comply, you can go through enforcement. If they don't have defenses like a Fifth Amendment defense or something, you could use that to ask the court to do a consent directive, which is, even if you have a Fifth Amendment defense, you could require them to ask those foreign banks to release the information through a consent directive. So all these actions the IRS can take, it's a lot more, it's pretty involved, and some are hard for the IRS to do, but they can do them if there's incentive to, there's a lot of money involved. Another one is you can even ask for information. The IRS, this was one of my jobs when I was with the IRS, is to know all the liaisons the IRS has liaisons that they send to lots of different countries, really regions. So there's like an Asian region and South America and things like that. But you can contact that liaison who would go to the foreign government and say, hey, look, it's in your interest to help us get these documents from this bank. So can you issue your version of a summons to the bank in the foreign country and get the information and then share it with us? So that would also be a tactic used. Now, I will tell you, it was almost impossible to get anything from banks in China, but it is possible. We did get some sometimes. So those are some of the tools that can be used in these investigations. Briefly, I'll just mention that there's statute of limitations that are attached to everything the IRS does, but since these laws, especially the FBAR rules, are in a different code section, they're not in the Internal Revenue Code, and so they have different statute of limitations. Typically not everybody, but most people understand there's a 3-year statute of limitations on assessing a tax or a penalty. But of course, that can be 6 years if you omitted more than 25% of your income. And that would give you a 6-year statute without any international question or not. Now, of course, if you committed fraud, if they determine you committed fraud, which is essentially intent to evade taxes, that would allow for an unlimited statute of limitations. Now, crazy enough, though, with these forms, there's a special provision in section 6501, which is where you find your statute of limitations in most cases. That extends the assessment statute on all items on a return if they were even if they were unrelated or due to willful neglect. So basically, you could, if you didn't file it, or you filed it but it wasn't substantially complete or accurate, the IRS can assert that there's an unlimited statute of limitations on those forms. Now, specifically for FBARs, they're in a different section of the law, and so they come with a 6-year statute of limitations, kind of a hard and fast rule from the IRS perspective. 6 years from the date that the FBAR or FinCEN 114 was due, they can assess the penalties related to that tax. Jared, if you move on to the next slide there.
There we go.
Just some brief more information about those FBARs. So when you do, most common, this is the FBARs, right? Well, that's basically you didn't report an account. And this, Jared, and I see this in lots of different ways. I mean, sometimes there's 5 different accounts that add up to 10,000, but they were all very small to people, and they thought, well, I didn't, none of them had enough money, or again, there's the life insurance can cause a problem. So because this gets triggered often, you have to remember you'll get audited often. But they can't audit you since it's in a different code section unless they get this related statute memorandum. And it's basically getting approval from their manager to investigate whether or not you have FBARs that weren't filed. Now, the important thing is they do have discretion. They can decide whether or not to go after you for penalties or issue a warning letter. And that's really going to be based on what we mentioned later is like, you know, how much willfulness, or was there willfulness, or was there non-willfulness but no reasonable cause. And again, the collection statute is different. They only get 2 years to initiate a suit, but they can, for 10 years, offset your refunds against any penalties they determine. Now, of course, if there is willfulness and they find that you could have, you intentionally, essentially, didn't report, they can go after you criminally. That is some of those risks. Now I'm going to have Jared's going to turn it over and talk sort of about how much these penalties can be and why they're so difficult.
That is the question that I get quite a bit is if these forms are informational nature, why are they such a big deal? I've kind of already talked previously why, what the purpose of the forms are, and it's because of these large penalties that make this such a big deal. This screen and the next one will kind of show you some of the penalties that are in existence out there regarding the delinquency or filing of this form. I also want to point out that sometimes on some of these forms, the IRS will assess these penalties if the forms are not considered, in their opinion, substantially completed. So if you are a tax practitioner or an individual that does your own return and you just put in what you think is the bare minimum and it doesn't meet the IRS's satisfaction of being considered substantially complete, you could be subject to these penalties as well. So the FBAR is the big one here. Again, the most common. So you can see that a non-willful filer of an FBAR could be penalized $10,000 per account per year for failure to file. If they're willful, these penalties go up substantially, the greater of 100,000 or 50% of the account balance. And there's potential criminal sanctions for failure to file this form. 8938, again, which is the same information as the FBAR for the most part, but it gets filed with your tax return, is not filed separately like the FBAR is. This gets filed and attached to your tax return. This penalty is a $10,000 failure to file penalty. And then if you continue to fail to file, it's an additional $10,000 penalty for each 30 days up to a maximum of $50,000. The 3520 and 3520A, you can see the penalties here that they, the greater of 10% or a percentage of the value of distributions or the assets held in the trust. And you can see that the 3520A does carry with it a potential criminal penalty. So the next page has the rest of the forms, the 8865, 5471, you can see the different penalties here, as well as the 8858. The one thing that on this slide that I want to point out that is a little bit different than all the others is the last one, which is the 8621. There actually is no civil penalty for the failure to file this form. This is the PFIC form. I guess I would like to say this is still kind of is still a penalty, but it's not a civil penalty, and that is that there is no, if you fail to file the 8621 and you should have, there is an unlimited statute of limitations on your on that. So opens up your tax return indefinitely, basically, until you get that form filed. So,
Jared, does it matter for these whether you're an individual or a sophisticated big company or just a small company with very little transactions?
no, it does not. And we're finding that with the IRS, the more and more you would think that the IRS would have more leniency toward, maybe an FBAR with $250 in it, if, now again, that FBAR filing is in aggregate. So if you have two accounts and they each have $5,000 in it, you have to file the FBAR and report both accounts. And so that's why you have to report some accounts with $250 in it. And if you failed and you missed it, there's some agents that have no leniency at all. There might be more leniency depending on facts and circumstances if you go through the audit procedures. But through the programs that we're going to talk about today, I don't know if I don't think there's very much leniency with them. So with some of them.
I would say, when I was in the IRS, they kind of gave a lot of that leniency, but I don't know if they're training it out of them, right? And telling them to be stricter. And so because it seems to be there, right? But it's sort of there, because it's something they can do, not something they have to do. Yeah. But you and I are running into them that say, well, I've got to do it if I can do it. So
yeah. A lot of them are like, this is the way we're treating all people under the circumstances. So it's almost like you're trying to beat it out of them. And so really the only way you get that leniency is if you push it on, if you're in one of the amnesty programs that we're going to talk about, and they're not being very lenient, you push it into the audit process or something, you get another agent involved, then you I think that's what you were indicating there, Ben, is that the further you push it, you might have more leniency there, but up front, no. And it doesn't matter if your company it doesn't generate any income. It generates losses. If you're not filing 5471, a lot of those agents' eyes, too bad, so sad, you're going to get assessed these penalties. Okay. This leads us to polling question number 2, Amy.
All right, polling question number 2 is open. Can the IRS prosecute an individual with criminal charges for failure to file an FBAR? Yes or no?
So I think all your other slides mentioned there's potential criminal implications on all these, but I mean, how realistic is that? Are there any recent criminal cases?
Yeah, the one that comes to mind right up front, it's probably pretty notorious, is the FIFA soccer officials. A lot of those persons that were part of FIFA that when they raided their hotel in Switzerland a few years ago, there were several U.S. persons, and some of the charges they brought against them were FBAR penalties because they were U.S. persons and they weren't filing their FBARs. So there's also some common U.S. cases out there, Ben. U.S. versus I can't remember how you say it, Khalili, and where they assessed a $5 million FBAR civil penalty and sentenced the individual to 8 to 12 months in prison. And then there's U.S. versus Horsky. There was a $100 million FBAR penalty, and there were sentences up to 6 years. Now, I don't want this to sound like we're trying to scare you. This is mainly just to make sure you're aware of the severity of this. And a lot of people think, oh, I don't have very big accounts, it's not a big deal. Well, if the IRS thinks that you are willful in your failure to file these forms and you're not reporting income from these assets, it can get really serious in a hurry. And
Hey,
so,
but maybe you should scare them, because 25% of the people said there was no criminal.
yeah, there you go. But yes, there is. Yeah, to answer the polling question, 25% said no, there is no criminal charges or criminal penalties. There definitely is the possibility for that.
So these are pretty hefty penalties, and they're draconian, as some would say. What can you do about them if it looks like they're going to be asserted against you, or they could be asserted?
Okay, that leads us right into the next section of our presentation. And this is where we're going to talk about the various different options that mitigate all those risks with failure to file these forms. So let's start the next slide. All right, so this is a list of the various programs that we're going to go through each one of these. So I have a lot of people come to me and they say, well, how can I come clean? I haven't been filing my FBARs. I haven't been reporting my ownership in foreign entities, or so, whatever the case may be. So what I commonly get from people are, well, geez, if I start just reporting it now going forward, am I not opening up Pandora's box where the IRS is saying, well, geez, you're now filing FBAR and you haven't in the past, and we have information shows you've had the accounts. Am I opening up myself to all these penalties for all these past years? If so, I don't want to do anything. And that's what a lot of taxpayers were faced with. And the IRS is encouraging people to come clean right now. And they've offered several amnesty programs out there to help individuals come clean. Basically, what they're doing, in their opinion, is they are throwing a lifeline out to individuals or whatever entity it may be that have these delinquent assets, and saying, hey, enter in one of these programs as a means to come clean. And these amnesty programs which we're offering may minimize those penalties that could be assessed, and gives you kind of a way out, because they want you to come clean and start reporting and being fully compliant going forward. So that's what we're going to talk about right now, is just these various different assets. All right, so who can participate? All U.S. taxpayers who are required to file U.S. tax returns and disclose foreign financial assets or file other foreign disclosures may be able to participate. So there's quite a bit in that little statement. So what is a U.S. taxpayer or a U.S. person? And that's the first question you kind of have to ask yourself. Under the IRS code, a U.S. person is a U.S. citizen or a U.S. resident. And for those people to meet this, as a resident, you either meet the substantial presence test or you're a U.S. green card holder. So what I like to say to people, my first questions to people are you a citizen or are you a green card holder? The answer is no. Are you here in the U.S., under maybe a work visa or something, and do you meet the substantial presence test? And what the substantial presence test is, it's a look back rule over 3 years. And basically you count your days in the U.S. over how many days you spent in the U.S. And I'll just kind of rattle it off right here, but you meet the substantial presence test if you've been in the U.S. at least 31 days in the current year, and you are here in the U.S. at least 183 days or more under the following formula. So the way that they look at that is you look at 100% of your current year days, a third of your days in the year before that, and 1/6 of your U.S. days in the year before that. If the sum of those three add up to 183 days, you've met the substantial presence test and you're a U.S. person. So that's kind of how that works. The U.S. entities, you can only file under the streamlined program, which we'll go over in just a minute. That's usually only for individuals, and estates of individuals are able to participate in that program. Under voluntary disclosure practice, individuals and entities such as corporations, partnerships, and trusts are eligible to participate in those. So that's kind of in a nutshell who can participate in these amnesty programs that we're going to go over. Okay, I just need to use my arrow buttons, I think. So there we go. All right, so this leads us to the very first program, and this is where Ben talked about some changes that took place. And this is the first one. This is the first change. So we're going to talk about. So there used to be a program called the Offshore Voluntary Disclosure Program. It grandfathered out in 2018, September of 2018. So the only way that program is no more. You could only be a part of it right now if you were currently in the program, and that's the only way you could be in it right now. There's still some stragglers are kind of trickling through, and the offshore, I call it the OVDP, so which is an acronym for Offshore Voluntary Disclosure Program. So the OVDP program was a formal program. You had to formally get accepted by the IRS to be in the program. You had to be accepted by them. They would send you a letter and tell you that you were accepted. Once you're in the program, you had to file 8 years worth of delinquent returns. And you had to pay a one-time 27.5% penalty under that program. Well, that again, that program is no more, and they've replaced it with this IRS criminal investigation voluntary disclosure practice. And this is handled right up front by the IRS criminal investigative unit to kind of give you an idea how serious it is. This program is designed to limit criminal penalty and exposure. It's not designed to limit civil penalties. Therefore, unlike the OVDP program that this replaces, it doesn't have a cap on 27.5% penalties. It just says, hey, the IRS agent is it can subject you to the penalties that are due to this. So you're just kind of going in with this, hoping for the best that you don't get thrown in jail on this program. This is for the people who are willful, and you basically are agreeing to deal with the penalties that are associated with it. I think this is a much more harsh program than the OVDP program was. You only have one thing that isn't as harsh is you only have to file 6 years worth of returns and FBARs instead of 8. But really, I mean, this is something, unless you are really afraid of willfulness and you've done something that that could, warrant criminal charges, I don't think this is the program for most individuals that we see. But it is an option, and when the Offshore Voluntary Disclosure Program went off the board, a lot of people were, well, what about the people? What happens to the people who are willful? And so this is what replaced them.
Yeah, and this should be something you do after consulting with the criminal tax attorney and
exactly
deciding that's your best option.
Mm-hmm. Yeah. Thanks, Ben. That leads us to the next program. I didn't learn my lesson. Okay. I got to use my arrow buttons here. So this is the IRS relief procedures for certain former citizens. This is also brand new. And this is designed for, and this is really to benefit individuals who I would consider or call an accidental U.S. citizen. And people say, what's an accidental U.S. citizen? If you are born to a U.S. citizen, or you were born in the United States, under IRS code, you are a U.S. citizen, and just by virtue of birth. And there are millions of people out there who have been born to a U.S. parent, and they may not even realize it or even thought about the implications of it. And the only way that they learn about it a lot of times is because their bank notified them, because they told them in a questionnaire that they were born to a U.S. citizen. And that bank says, it sends them a letter and says, we call them a FATCA letter. And it basically tells them, we've identified you as a U.S. person, you have bank accounts in our bank, and we're disclosing them to the U.S. authorities. And so that's how a lot of these people are coming to know about their filing obligations. So this program is really to help them. Go ahead, Ben.
So even if you never got a social security number?
Even if you never got a social security number, you normally before this program, you would have to go get one. Or if you decide not to use this program, you would have to go get one to meet your U.S. filing obligations. You'd have to contact your consulate, apply for a social security number. And it does happen, unfortunately. So really this program is very limited, but it does help a lot of people who don't have a lot of tax and they're an accidental citizen, that they don't have a social security number, and they don't want any ties to the U.S. In certain cases, they've never had a passport and they don't want one. And so they're like, why do I even want to have citizenship? Or I never go to the United States. So I don't even want citizenship. So this allows them to file 6 years worth of returns and immediately relinquish their citizenship along with it, and not require them to get a social security number. And when they file these 6 years worth of returns, assuming they meet that aggregate $25,000 tax liability, that's how you qualify for the program. But if you have that liability or a tax due, that's liability. So anyway, but if you have a tax due with those returns, you don't have to pay the tax due either. And so it's really good for those types of people. And this is a brand new option that's out there as of this year. Okay, now this is the most common one. This is the Streamline program. So I'm going to talk a little bit about, I jumped down just a little too far. So the Streamline program was implemented back in 2014. And it was, and really there's two, it's designed, and Ben will go over this in just a minute. So there's a non-willfulness test to be part of the Streamline program. You have to be non-willful in your failure to file. And so Ben will discuss what non-willful is. There's two iterations of this program. There's a foreign piece and there's a domestic piece. And as you can kind of see through on this slide, the penalty for a foreign individual is a 0% penalty. And we'll kind of go, the reason why is because the IRS wants to be more lenient or compassionate for somebody that lives outside the US. And really the foreign piece is you can't meet the physical presence test in the US for any of the 3 years. So under the Streamline Foreign, you're filing 3 years worth of tax returns, delinquent or amended. You don't have, you aren't required to have filed an original return, and you file 6 years worth of FBARs. And so these are, this is the ideal program that you want to be in. But under that 3-year period of tax returns, if you are in the US in any of those years for less than 35 days, then you would meet that foreign hurdle and you could be part of the foreign program. So anyway, so that's a little bit about this program. It's a little bit more lenient than the next one. So this is a streamlined domestic. So both of these programs are not formal. You don't have to ask the IRS for approval in these programs. You just apply, you just file. So, but you can kind of see here under, there's a 5% streamline penalty. And so the way that's assessed is you, over the 6-year period of the FBARs, you look at all the accounts that had unreported income, and you take the balance of those assets that max out over that 6-year. So if like in year 5, all of those assets accrued peaked out at $100,000, you take a one-time 5% penalty on that $100,000. And that's how the streamline penalty works. The reason why it's more, there's a penalty on this one, not the foreign, again, it's because the individual's located here in the US, they're not from overseas. And so in most situations, sometimes there's a loophole that, but in most cases it's somebody that's living here. And the IRS is more strict on this because they think if you're living here, you should be able to find competent tax professionals to help you, or you should be able to find the information yourself to know how to file these forms.
What if you have assets that are worth millions of dollars? They didn't generate all this U.S. income, but they had a high value.
Yeah, and so that's where it would, under the rules of this program, you would be subject to the 5% penalty on the value. Like if it's stock in a foreign corporation, a privately held corporation, and that corporation is worth millions of dollars, technically you would have a 5% penalty on that value of that stock. How you value that stock is very subjective, and you might be in get in a back and forth with the IRS on that. There are other options, like if that is not, you don't feel like that's just, and there is one of these other programs we could do, filing under reasonable cause, that if you think you can argue a lower penalty and try to get in, but again, that's when you would want to hire a tax attorney that does this type of work to kind of to figure out what your options are there. But yeah, that's a real concern with this program.
All right, polling question number 3 is now open. What is the streamlined penalty filing under the streamlined foreign procedures?
So Jared, we've seen different programs come and go and be phased out. How long are these streamlined programs going to be around?
We don't know. The Offshore Voluntary Disclosure Program grandfathered out. Before that, they'd never had a program like this streamline. And so this is a really optimal program that's out there. And my recommendation is take advantage of it, because we really don't know how much longer it's going to be around. And the IRS could usually, when they do grandfather one out, they have a period of time where it's usually around a little less than a year, I think, is my experience, is when they will kind of grandfather out. So the polling results the poll has ended basically, and so 50% answered 5%, which is a correct answer. And 27.5% is the other major one, major vote getter. That is 33%. That is the penalty amount that was under the old Offshore Voluntary Disclosure Program. So the streamlined penalty is 5%.
And so you said 0 is the answer, right?
Oh, let's see, the streamlined penalty under the
foreign.
I missed that. So streamlined foreign is 0%. So it even tricked me there. I got to read that a little bit closer. Anyway, yeah, you're right. So the streamlined foreign is 0%. The streamlined domestic is the 5% penalty.
Okay. Well, so under all of those programs you talked about, you had to be non-willful, right? Or yeah, well, except the first one with the when you have to go through CI, right? Because technically you would only do that if you're willful. But so what the heck is non-willful and what is willful? We kind of put it in three buckets, I would say, right? We have reasonable cause bucket, because if you have reasonable cause, then you're not non-willful or willful. You're non-willful, but you're also no penalties are going to apply, right? Even since there's different categories of penalties, and they can get worse if you're willful, and they're in the middle, you can get to zero if you have reasonable cause. So, but let's go over the definitions a little bit, try to figure it out. It's very subjective, and I think the problem with the IRS changing all these programs each time is every time you retrain the agents, then we get different results, right? And there's not only a bit of us learning how the IRS is going to apply different rules that they create, but also the agents figuring that out, because I think every agent we talk to has a different idea of what something's willful or not. They can get hung up on one factor, and we'll talk about some of the factors. But just reading the definitions that we pulled. So if you're non-willful, your actions were conduct that is due to negligence, inadvertence, or mistake, or conduct that is the result of good faith I think should say it's a good faith understanding of the requirements of the law, but I think it's a good faith mistaken understanding of the requirements of the law, because they believed that that's what the law was correct, and they did some due diligence, but they got it wrong, right? Or someone told them wrong, but then they might have reasonable cause. So willfulness, though, that has become more difficult to figure out, because here's the definition: willfulness requires a voluntary violation of a known legal duty. But in this Williams case, so everybody kind of thought, well, if you're willful, you had to know that this was something you were supposed to do, and then you decided not to do it, essentially, and you took relative voluntary actions around that, avoiding that duty, which would trigger bad penalties and possible criminal implications. But now they have this whole it's not necessarily new, but it was sort of sustained by the Supreme Court. You can have this willful blindness, and this U.S. versus Williams case. They said, well, this person didn't necessarily have that understanding of the law of a known duty, but they worked really hard to make sure they didn't get an understanding of that known duty. So they were taking actions that were also voluntary to avoid knowing for sure that they had this responsibility, sort of avoiding it, right? Willfully avoiding it, they call it willful blindness. So that kind of adds a wrinkle, because now we have agents that are trying to say, well, weren't these things you did kind of like what happened in Williams, where you could have done something more to figure this out, and you intentionally didn't do it, right? So it just makes it, when we're writing these cases up, it's more facts you have to worry about and be concerned about. Now, of course, I just want to have you have a quick understanding of how it works. So usually, to me, when I would deal with this and with agents in the IRS, they're first focused on what your education and experience and knowledge is. And if they kind of think that they kind of put you in two places: one, a sophisticated financial person that should know to contact your tax professionals, other than your just a common CPA, but someone that has international tax experience. Then they try to figure out, well, what did you do with that when you spoke to that person? Did you advise them of everything, divulge everything, or did you, when they ask a question, did you just answer it technically but leave some things out? But then it becomes, well, so once we figured out that yes, they fall into the bucket where they didn't intentionally or voluntarily avoid or head in those routes, they just committed negligence, like they could have done more, but they didn't. Some of the things that we know, and then the next step they'll do is they'll say, well, now is this reasonable cause, right? And reasonable cause is different than in a lot of other penalties when it comes to international penalties. but we do know that a lot of agents will focus on, that it can't just be your beliefs, that your things that your friends told you, or that you didn't have a very understanding, and it's a complex area of law. Can't rely on the fact that it is complex. And really, though, they've kind of discounted from this full cooperation, although I think that's still part of it. Here's some of the factors that willfulness considers, right? Well, was there knowledge of a reporting obligation? Obviously, if there was, and then you didn't do it, you were voluntarily chose to not meet your obligation. Was there a conscious effort to avoid learning about the FBAR filing? This gets back to the willful blindness or any filing. So did you say, oh, you found some information but didn't seek out more information to figure out whether or not it applied to you? So you knew that there was a possibility, but you didn't vet it out. Now, of course, I always think that practically, when I was with the IRS, it all started with, well, where are these funds and why are they in this foreign country, right? And then the next thing was, well, was there really income generated from this, and was this reported somewhere, if it was in a foreign country or United States? Because most people familiar with foreign reporting know that if you're paying a lot of tax in another country, you're probably not going to have a lot of tax in the U.S., although you could if you failed to report it on one of these forms, both countries. Then, that's the disclosure part, which is this next one. Did they disclose it? Because so we'll have taxpayers that didn't file the required forms, but they were reporting everything, reported all the income that came from it. So it's very hard for an IRS person to hit them with all the penalties in that situation, and definitely not willful if you reported everything. But if you didn't, then that's a voluntary act showing that you intended to hide it. And then, of course, what I just mentioned, did you report in the foreign country? Then I think this is important, although this is, the courts have said it's not an absolute rule. What did you do once you found out, right? Now, of course, you can become willful. If you found out and you knew that it was wrong, and you said, no, I don't want to do anything, especially if you told your preparer that. The others are, all these things can be seen as an attempt to conceal. So if you took other actions where, some people put things in trusts, or there's different versions of things like the offshore credit card programs where they put money there so that it was harder for the IRS to find, and did they keep the transactions below the reportable amounts, things like that. So we'll move on to Jared again to kind of wrap up.
So these last two, so we're right up on time. So these last two are kind of the last two are pretty quick. So the delinquent FBAR filing procedures, that is if you have no unreported income from foreign accounts, you just didn't file FBARs, you can file up to 6 years worth of FBARs, and there's generally a 0% penalty on it. The IRS accepts them. It's pretty easy. This is probably the most simple amnesty program that's out there in this situation. The next one, this is the one where it's kind of like a streamline. It doesn't tell you how many years to file. There's no penalty you pay up front with it, but you're filing basically the returns, and instead of attaching a non-willful statement, you're attaching a reasonable cause statement, which is a little bit harder to prove. In which, if you guys have further questions about this, you can talk to us about it. We'd be happy to answer any questions. But this is like on the streamlined domestic, if you haven't filed returns, you're not eligible for the streamlined domestic. So a lot of times you're filing under the delinquent international informational disclosure procedures. And so with a reasonable cause statement, we can help you derive those reasonable cause statements and so on and so forth. So that really gets us our last polling question, and we're 1 minute over. So we'll move on to that, and then any questions if anyone wants to stick around after.
All right. Well, you guys go ahead and answer this last poll. Ben and Jared, if you want, you can actually close the poll on your screen and you can continue on and we can get wrapped up here.
Okay, so have you ever filed under the IRS's prescribed amnesty programs? There's one that has said yes, which is interesting, and then others no. If you guys haven't, if any of you have questions, either the one that is answered yes or any of the others, would be happy to talk to you about them if you guys have any lingering questions after this.
There's one question too, Jared, that says, if the IRS does a FinCEN query, I think this is Elise, she's works with me. She's a former revenue agent, so she's maybe opining here. They can get foreign bank account statements and total deposits as long as the bank is involved in the U.S. treaty.
Yeah,
that is true. That's also kind of what I was mentioning there. You can actually do a summons from domestic. Sometimes a bank just has a branch that facilitates those check cashing transfers, and you can get that, but you'd still have to search through the deposits. But
yeah,
the IRS can get that.
but anyway, yeah, it was a pleasure being with you guys today. If you guys have any questions, feel free to email Ben or myself, or give us a call. We're happy to talk you through it. Or anyone you know that has any of these issues. We would again recommend that everyone just kind of get in front of it. So as soon as possible before the programs go away. So anyway.
All right. Well, thank you all so much for attending, and thank you to our presenters, and we hope you guys have a great day.